Gold still shining, hitting fresh record highs and pushing above 4,100 an ounce. This comes as President Trump floats more potential tariffs and investors flock to safe havens. But our next guest says the rally, it's more about fundamentals than fear. Joining me now, we got David Miller, CIO and Senior Portfolio Manager at Catalyst Funds. David, great to see you as always. So first big picture, let's talk about what's kind of just driving this run in gold. You put it like this, David, you say the move to all-time highs isn't just about fear, it's about fundamentals. Explain that for us, David. What do you mean?
Well, so it's certainly not just one thing. So I guess to start, an easy way to think about it would be those China tariffs you just mentioned. If you think about it, if you're China and you're running the Chinese central bank and you own 760 billion of US treasuries, and you just saw that the US was threatening 100% tariffs, and you saw that back in 22, the US seized 300 billion of Russia's dollar-denominated assets, you'd probably feel a lot safer if you held 760 billion of gold bars in a vault in Beijing that we couldn't take at the flip of a computer switch. So that's probably a starting point, is you have these price-agnostic buyers, and it's not limited to China. They're not the only people we put tariffs on or indicated that we may not agree with their policy and don't want us to have that leverage. So they're an enormous buyer, over 1,080 metric tons last year, and they'll likely do more than that this year, meaning the central banks, particularly of the BRICS nations.
Central bank buying, it's an interesting trend to watch. Is that in and of itself, David, enough to keep gold moving higher?
Absolutely. The central bank buying is enormous because if you think about it, the US dollar as the world's reserve currency fundamentally started to shift after that weaponization of SWIFT in 2022. And then it really just poured gasoline on that fire when you added the tariffs to it earlier this year.
What about US-China trade tensions? I mean, you saw that caused a freak out in the markets on Friday. What role do you think that's playing here?
I think that's pouring even more gasoline on the same fire. So, there's already this concern. We already had these tariffs earlier. We already had specific Chinese sanctions. So any addition to that just makes people want to transition off the dollar faster and buy more gold as a reserve asset.
Let's put some numbers on this. What are your gold targets? What do you pencil in?
So it's obviously been moving pretty quickly. We just got over 4,000 an ounce not too long ago, then starting to crack 4,100. I think middle of probably end of this year, you're probably looking 4,500. You could even see 5,000 plus a year from now. A lot of it obviously depends on those fundamentals and how they shift over the next few months and year.
For gold investors who are listening right now, what are, David, near-term risks you would emphasize that they need to have on their radar?
So obviously the price has obviously moved a lot. So whenever you see an asymmetric move like that, there's always the risk that it will retrace. I think the reason that's less of a risk right now is we have the Fed lowering interest rates. That's generally good for both bonds and gold. You also have the central bank buying. That's generally accelerating. So that's also pretty good for gold. Obviously, if either of those were to flip and they flip to raising rates or they flip to central bank selling, that would shift it. But there's no indication that either of those two are likely to happen. And then you also have deficit spending, which is the other big driver, which is also weakening the dollar because when you have 37 trillion in debt outstanding and you're running a $1.9 trillion deficit that was kind of enshrined into law in the big beautiful bill, those factors are very structural. So obviously if any of those shift and they flip to selling or they start raising rates, or we see the government decide to run a balanced budget and create a new bill that reverses previous ones, that could change. But I don't think that's terribly likely in the near future.
So those are near-term risks. Would there be some potential near-term positive catalysts? Would it be like the next FOMC meeting?
Certainly. So, if the Fed decides that they're going to loosen policy and cut rates more than they've already indicated, that would certainly be a net positive for gold. If they decided that they were going to cut less or not cut, that wouldn't help gold prices. And you can think of gold in relation to the dollar from that perspective. Whenever the dollar weakens, that's a big net positive for gold on a relative basis.
What have gold ETF flows been like?
So gold ETF flows had been flattish the past couple of years in spite of the rising price, whereas year to date they've really started to take off in a much more significant way. They're not nearly as big as the central bank net buying, but that's an additional part of that cycle. The price escalation has attracted more buyers. It's certainly one of those situations where it's kind of a bit of the opposite of the store sale. People like buying gold more when the price goes up, ironically.
When friends and family come to you, David, they say, how do I get exposure to gold? What's the smart way? Do you say physical gold? Do you say ETFs? Do you say miners? Do you say all three?
So I think all three could have their value. So we've kind of approached this on our own. So we've created one ETF. It's called the GOLY ETF, Gold Enhanced Yield ETF. And what that does is it buys gold futures because gold itself doesn't pay a yield, but gold futures do deliver the price returns of gold, but it frees up the rest of the money in our fund that we can put it to work, generating income in investment-grade corporate bonds that throw off a 5% yield to maturity. So we can stack that 5% yield on top of those price returns that we're getting from gold futures. That's been great for our fund. It's been up over 50% year to date. You can also own the physical. That's certainly the cheapest way to do it from a storage cost perspective or management fee perspective. But then you have the risks of selling it. You usually have to sell it at some type of discount. You're paying a premium when you buy it, whereas that's not really true in the futures markets or when you buy an ETF. Aside from the ETF route, though, gold stocks have gotten considerably more attractive because gold stocks really trade off of their margin. And when you think about it, over the past few years, gold prices had gone up, but their margins hadn't really improved significantly because the costs associated with gold had gone up with it. That really started to change this year as their margins really started to widen in a significant way because the gold rally has been much more significant than any costs associated with mining gold so far in 25.
Final question, David. I'm just curious, what would you have to see? What would need to happen to really kind of weaken your fundamental constructive view on gold? What's the headline where you would say, okay, that's a sell signal?
So we started to have some of those earlier this year, although they reversed. So earlier in the year, the government was talking about DOGE and what they were going to do to cut deficit spending and cut $2 trillion off of spending. And that would clearly be a net positive for the dollar, and that would be a net negative for gold. Now, they didn't follow through with that, but if they decided to reverse course and try to do massive DOGE-type cuts, that could certainly have an impact. If you had the government say, hey, we're going to drop all these tariffs, we decided we're going totally for free trade, that would be a net negative for gold, although that doesn't seem to be the trend right now either. Or if you had the Fed reverse course and say, hey, we're actually going to hike by 50 bips over the next few months.
You're outlining what sounds like some pretty low probability events.
And that's, I think, why gold's been rallying, because you have all these factors that are tailwinds all working at the same time.
Yeah, David, always great to see you, especially on set. Thank you, sir.
Oh, thank you.
Precious metals are on a historic run. Gold holding above $4,100 an ounce. Silver just topped the $50 mark. Joining me now on the commodities, precious metals trade is Bob Iacchino, Path Trading Partners Chief Market Strategist and co-host of the Futures Edge podcast. Good to see you, Bob. So it's been all about gold, but now we are really seeing it spread in more dramatic fashion to the other precious metals as well. I mean, what do we think here? How far can this gold run go?
Well, as you're probably seeing, Julie, it's good to see you again as well, by the way. Silver has obviously just reached a new all-time high. And the interesting thing is when you look at the performance, I flipped positive precious metals in November of 2023 on this show, actually. And if you look at silver, silver was not on my radar at all. And you compare the performance of the two since then, gold's 133%, it's just short of 134%. Silver's now about 130.5%. So right on the heels, and most of that movement has been lately. And I think it's in part due to the nature of the Fed rate cuts that we expect to see coming. Nobody is saying that the economy is slowing dramatically. It's clearly slowing. But if you get rate cuts, now you're seeing the industrial part of silver and the safety part of silver kicking up a pretty good fire behind silver to have it catch up to gold. The silver to gold ratio has been out of whack for quite some time now. And then on top of that, silver is what people call the poor man's gold. I don't think anybody that's been in precious metals is poor lately, but it's been known as the poor man's gold. As gold rallies up, the reason for the catch up between the silver and gold ratio is people start to think that silver is overdone, and gold is overdone and silver is a cheaper alternative. That isn't necessarily the case. I think what's driving silver now is the combination between the industrial use and the precious use of silver. Gold, on the other hand, I had a $4,000 target. It's blown through that. Kind of working on a new target that maybe I could tell you guys by the end of this interview.
You're thinking while you're talking on what the new target should be.
Thinking while I'm talking.
Interesting. I've also been reading a little bit that's in terms of silver that there's maybe a short squeeze going on as well. Again, what does all of this tell us about the sustainability of the move and how much it's going to keep going?
So here's what I'm looking at for that. The interesting part about gold over the last 2.5 years, as the corrections have been sideways in price. Now, unless you look at charts as often as I do, I tell people all the time, I'm probably 30% fundamental, 70% technical. Lately, I've been leading 80% technical because with President Trump, the fundamentals have been kind of out of whack, especially for precious metals. When you look at it from that perspective, gold's corrections have been sideways. And people don't necessarily look at those as corrections, but I do. When you have a strong trend that all of a sudden levels off and goes sideways, that tells you something above the psychology behind that particular asset. And the psychology of gold has been, I don't think it's going higher, but I'm not going to sell it. And that's really sort of a short-term comfort with the position. So when the next crazy thing happens in the market that drive people to gold, some people are already in it, but other people have FOMO and they drive it higher. So for me now, we are looking for a downside correction in gold. Today, tomorrow, that could be the exhaustion. I'm not willing to sort of pick a top on gold. But I think if we get a move back down to 3,600, I can then put 5,200 up as the 2026 target for gold because you'll get that sort of exhaustion. But as I look at the overall fundamental case for gold, I can't see a reason for it to drop precipitously and stay there. There's just too many moving parts for gold right now that drive its nature. You look at, for example, Friday, when we had the threat of tariffs that you guys just talked about, the Chinese tariffs. Gold is the only thing that rallied. All other risk assets dropped, and I'm not putting gold in a risk asset. I'm just saying Bitcoin dropped, which again gives you this idea that Bitcoin hasn't quite reached gold status yet as a pure safety asset. It's still too correlated to the moves in the NASDAQ. Now we see the NASDAQ futures, obviously the stocks are closed, NASDAQ futures are up 2%, and Bitcoin is rebounding, not as much, but a little bit off of its lows.
Right.
So it tells you that gold is still the safety asset when it comes down to it.
Yeah, I would hazard a guess there's a lot more margin buying in the crypto market than margin buying of gold, but I don't know. That's just a guess, Bob's. Okay, so your new target, did I hear you correctly, 5,200 for gold?
Yeah, I really don't call that number with the idea that there's going to be a sideways correction in gold again. If there's a sideways correction, I'd put it more at about 4730. But if we get a correction to about 3600, my new target will be 5200. It's based on the play. You know, when you get a sell-off, you get people that have been sitting on the sidelines saying, I should have bought gold, getting in again. When it just moves sideways, those people tend to not get involved. They tend to wait for a sell-off. So I'm talking 4,700 to 5,200 in 2026.
So, Bob, that could keep going higher. We talked about silver. I'm also curious about, say, palladium, platinum, and that part of the trade. Do you expect that to continue to sort of also catch up and participate?
I don't feel like platinum is going to catch up because it only has really one use, and that's in a use that's kind of evolving away. Right, and internal combustion engines is its strongest use. We have had a dip in electric car purchases, but then we had a spike just past that. So it was almost like a correction in electric car purchases. I expect electric car manufacturers to actually find ways around the tax breaks that have expired now. I think they're going to find ways around that. I don't know what those ways are going to be. Tesla already announced some financing advantages for going into Tesla. They make up about 2,500 of the 7,500 that went away. So I think they're going to work through that, and that could potentially stabilize platinum. Palladium's a different story. There's other uses for palladium. It's a rare earth. It's a precious metal. And I think palladium will continue to rally as well.
Bob, great to see you. Thanks so much.
Good to see you as well.